Welcome, everybody. This is Axel Merk, President and Chief Investment Officer of Merk Investments, with the May edition of our US equity market chart book. I'm speaking here on Monday around market close on Monday, the 13th of May. And this chart book was prepared as of last Friday. And so my comments are going to reflect a lot what's been happening in the markets today. And by the time we release this on Wednesday, who knows what else is going to happen in the market. One of the reasons why Nick prepares these charts here on a monthly basis is because if you want to talk big picture, you want to see the historic context, those things don't change. Now, obviously, you can argue, hey, with the market down several percentage points, yeah, a lot of things change in my portfolio. But it's really a different investment approach on whether you approach for the microsecond or for the long term. And so there, I'm not suggesting that one is better than the other one, but they provide a different sort of investment analysis, sort of approach. And all that said, even if you have a long-term investing approach, it is helpful to put the current events into the context of the long term. And so clearly, from one day to another, the earnings backdrop hasn't changed. We all know what has changed is tweets by the president, the arguments about tariffs and whatnot. And if I kind of take a step back, if I want to take the glass half full view, and a lot of people have been using a crystal ball, so let's take it for what it is here, what I'm about to say. But there had been a lot of criticism in the media about Trump being too soft, about not imposing the structural reform. And also, we are, is it 18 months or so ahead of the election? And so had a trade deal been made, well, that trade thing would have been out of the news. Now, obviously, one could have then argued about enforcement still later and so forth. But just politically speaking, being the tough guy, being in the news is a good thing. Now, I'm not suggesting that trade tariff is good, but just it's good politics to have trade in the news, appeals to the base, presumably. And then you can be the savior as we get closer to election time. I'm not trying to make a judgment here for or against Trump. I'm just saying from a political point of view, there is an argument to be made. Now, if you take that somewhat cynical view, then there is going to be a resolution, and everybody is kind of going to come to the table and be reasonable at some point. But of course, when it comes to these sort of escalations in trades, things can also go wrong. And in China in particular, the economic recovery had been just about nascent and might be deteriorating. As you see, I'm flipping here through the slides a little bit because I'm going to give you the background story, and you can study these slides here in more detail. But to go to the slide here for just a second, we've seen an uptick here on the German manufacturing PMI. That uptick is a positive. That said, even that uptick was a little bit weaker than expected. But you can see here China just hovering about that magic 50 mark. This is Purchasing Manager Index, and this is not for services, but for goods. Just to put it into context, the services PMI have actually never been looked all that bad here around. Both President Trump and President Xi in China, they each to their respective audiences want to look strong. And so one of the noteworthy things of late is, just as I'm digesting the news here of the last several days, is that the Chinese and a lot of their retaliation headlines have been, oh, we're not going to buy as many soybeans, we're going to buy more Airbus and less Boeing and things like that. And the quote-unquote good news in that is those are things you can then, in an agreement, turn around. So just as President Trump is accused of flip-flopping on things, and you can do the same thing when you come from the Chinese perspective, right? You increase tariffs, you play tough, and then to appease everybody, you back off again, and ultimately go back to square one, with some companies obviously having gone out of business because they couldn't deal with these issues. But from a big picture point of view, there is still a path forward here where everybody can save face. Some people have pointed out the G20 meeting, as of, I'm talking right now, Treasury Secretary Mnuchin has indicated he will go. Another sign they're interested in a solution. That's in late June. That's kind of the last moment, if it's not too late already, to set concerns aside about where to procure imports for the holiday season in the US. And so if there's no solution at that stage, then the holiday season is probably not going to look so good for Chinese exporters, for those who are dependent on exports to the US. And of course, the more of these bad news you have, the more you can drag down the Chinese economy, and with that, the global mood might deteriorate. If you look into details as to how the Chinese have retaliated or appear to want to retaliate, they seem to exclude finished cars, for example, for the imports into China, which is good for some German manufacturers that manufacture cars in the US. And so there's a lot of little nuances there, how headlines may be big. I'm not trying to downplay the threats here that come from a trade war. But at this stage, if you think this is all cynical politics, I don't think you should shrug off that view. If you're in the camp that no matter what, this is still bad, well, I'm not going to talk you out of that either. And so clearly the market's reacting to that is just fair and square. Now, put that into context, though, of financial conditions. Now, great, this is as of May 10th, which is last Friday as of when I'm talking here. And financial conditions are just fine, and maybe more relevant here in the context of what the Fed might do. As I'm talking, the expectations of a Fed rate cut were around 75% for December. Let me just mention that monetary policy cannot fix this. And it would be very helpful if the folks at the Fed said this much. Now, they may not want to specifically comment on trade issues, but it was Loretta Mester, the Cleveland Fed president, who recently spoke and said that many people are confused what monetary policy is about, most notably what it can and cannot do. Now, cynics aside, who have a problem with many things the Fed do in general, the point being is that the Fed is called to help with ever more diverse things, and the Fed should make it clear that it cannot help. And just to put into context, we had a discussion the other day internally and talked about the negative rates we have in the Eurozone. How can it be that the 10-year return in the Eurozone is negative on something in Germany? Is that really a monetary phenomenon? And or is it that maybe there's something else that's structurally just not right, something that monetary policy cannot fix? And I just leave that out there, and I'm digressing here a little bit from obviously just talking about the S&P, but I do think it's very relevant for the S&P because ultimately the S&P is a reflection of what's happening out there, and some of these market sentiment numbers may be stale by now. Brief talk here on volatility correlation. This chart here, if you're not familiar with it, dive into the details and read that here offline. The point here is that when times are volatile, when there's a panic, the correlation veers towards 1. And the one thing I like to point out is even at least as of Monday the 13th, we're not in a panic environment. As I talked, the Dow Jones is down. This may not be the final print for the day, over 600 points, S&P down around 80. But we have not had panic selling, I don't think. And part of the reason I say that is we look at many different markets. When you look at the volatility in the currency space, yes, things are elevated. And yes, the yen was the strongest performer of the day. And yes, gold was up 1%. But those are not signs of panic. Those are signs of heightened tensions in my book. You do not have a complete scramble for the exit. That is not the case at this stage. At least that's my take as of right now. That of course doesn't mean, hey, just because there's smoke doesn't mean there isn't a fire, right? I mean, that doesn't mean that you shouldn't panic. I don't want to say anybody should panic, but at this stage, if you are somebody who says, hey, have a calm, longer-term horizon, I don't disagree with that view. Now, all that said, I've been preaching diversification for some time, and I just mentioned that the gold was up. Well, you do with that as you wish, but it does show that gold, at least historically, has been a valuable diversifier. And the VIX curve here, this is something that will be updated, that where as we take the period of the current stress here, a lot of people are short vol, meaning they are trying to bet on volatility coming down, because in the medium term, it quote unquote always comes back down. And that may well be the case, but if you do that sort of trade, and if you do it with leverage, you may still blow up. And so the question is whether there is any quote unquote blowing up. And a lot of times when you have these down days in the S&P, you have what some people refer to as a washout. And these washouts are often a reflection of margin calls coming in, and then you really find a bottom. And the good news is that it is a bottom, I suppose, right? Yeah, this technical chart is going to look a little different in the near term. And here we go. I think we've moved this valuation chart towards the back. I think that's helpful because it's really just a reference point. It's not an accurate predictor of what's going to happen tomorrow, next week, next month or so. It's just this is a indication of how currently equities are valued versus bonds. And in the premium chart book, if you have a chance to get to that, there's a link to a Warren Buffett statement and video, and just talks about kind of a disconnect, how bonds are versus equities versus interest rates. And the question is where the adjustment will be. Well, today is an answer, right? I guess that equities are coming down in this context. Who knows? Maybe interest rates are also going to move higher. And I am still not away from my more isolationist view right now that interest rates may well not come down later this year. Now, obviously, if we have a huge fallout in the global economy, that will happen. But what's happening right now is political. It's not monetary. Lowering rates is not the right direction to this. And we'll see whether the folks at the Fed think the same. And yep, this is year-to-date return. Again, as of last Friday, that's going to change here. This is Nick's checklist, and he has some conclusions, which I encourage you to read offline. I can only encourage you to read the disclosure, and do look at the premium charts as well, and give us feedback. Thank you, and have a great day.